All right, it's time for our last session of day one of FTX 2021. This one is about IPOs. Now, IPOs are a term that investors use and it stands for, I believe, I want to pull out, so please take your company public. Of course, I am kidding. Now, going out in public can be frightening even as an individual, so imagine how companies feel. Many things can go right and many things will definitely go wrong. But who better to discuss this than the CEOs of India's hottest companies right now? So please join me in welcoming on stage for a fireside chat about the future of fintech and IPOs. We have Nithin Kamath, the founder and CEO of Zerodha, Yashish Dahiya, the chairman and CEO of PB Fintech, and Harshil Mathur, the CEO and co-founder of Razorpay. Take it away, guys.
Chat on future of fintech IPOs with two rock stars of the fintech ecosystem. One who has built and scaled an amazing fintech company, which has recently gone through a successful IPO. The other one who has a ringside view of all the IPOs happening in the country. So a warm welcome to Yashish Dahiya, the CEO of PB Fintech, which runs Policybazaar and Policybazaar, and Nithin Kamath, the CEO of Zerodha. Welcome both of you, and so glad to host you here at FTX. So let me start with a question for Nithin, right? And 2021 has seen one of the highest number of IPOs so far since 2010. What do you think changed in the last couple of years that led to this, right? Like, because you have a ringside view of this. So are there some ecosystem factors at play because of which a lot of companies are going public suddenly in this year?
I think there's just so much demand in the market, right? As in, it's just so many new retail investors, so much attention to India, so many people. I think the old school circuit in the capital market circuit have missed out on the startup industry completely. So they all want to participate in some way or the. I have a lot of these Bombay friends who feel very missed out, and they want to join the party as well. So there's a lot of demand for good companies. So. And I think why is there so much demand? I think it's on the back of probably one of the biggest bull markets of India has seen, right? So it's so there is a lot of greed, there's a lot of demand, there is just retail investors. I think we've been like 25-30% of all IPOs this year, in terms of a number of applications, and it is quite crazy how many new people are opening accounts just to apply for an IPO. So just immense amount of demand today this year.
Yeah, that's a pretty good view. Yashish, I'll ask a similar question, but as a founder, right? Like, when did you decide to take the company public, right? Like, what are some of the things that played in your mind, and what motivated you to say that we should go for an IPO? Is there some specific factors that motivated you to do that, or some things internally that helped you arrive at the decision?
See, all our shareholder contracts ever since we started the company had somewhere written in them that one day we will go public, because private equity investors many a times to that extent are looking for some exit, and even though they may not want to exit today, they always want to have the flexibility to exit should they wish to, and I think that is one driver. The second part is, see, we are in a regulated sector, and in a regulated sector, being held by PEs vis-a-vis being a public company has a different connotation in terms of your disclosure rates, your transparency in the market, and your conduct. And I think regulators per se prefer, it's good for the entire industry, I would say, specifically on the insurance side, because we are a little more on the insurance side. It is good that, one insurance distributor goes public. That brings a lot of transparency and a lot of credibility to the whole sector as such. And I think most importantly, last 20 quarters, because they say, when you are going public, you have to in some way be able to guide people, right? In terms of, and fingers crossed, we have been historically quite good. Like, I joke about it, right? When I started in 2008, we had given a business plan to Sanjeev, which had what would we do in 2012. And I remember that number was 25 crore rupees revenue, and we did 26.2. Now, it was a totally different business model, somewhat different business model, different stuff we were doing, and the business plans had nothing much to do, but the numbers were very similar. And it's just happened that way. So I think we had become quite good at being predictable. So we're quite a predictable business. Now, So over the last 20 quarters, it hasn't, the predictions that we had internally did not move by too much. Whatever they were, 2%, 5%, 10%. So we felt good about it that, because one of the things, see, there will be good times and bad times. Today is a good time, but it's, these good times may continue. I remember back and Nikhil is a pro at this, so he should speak about these things. But I remember being in India in 2006 or 2005. And everybody's saying, oh, the market's gone to 7,000, it's heated, it's going to crash. Yes, it did crash, but it crashed in 2008, by which time it had hit 21,000. And there was a lot to be done between 2005 and 2008. So I'm not trying to say anything about the markets, but all I'm saying is you don't know when, but there will be good times, there will be bad times. And I think if you're a little more predictable business, then during the bad times, you may not suffer as much. Or at least your retail investors will not suffer as much.
And then coming to the same point, right? Like, do you think there's a timing is a factor at play here, right? Like given it's a bull market, is it the right time to go public right now? And like if and when or sometime then if the market crashes, then you might not be in a good position to go public, right? So if you want to take public, let's say next 2 years, right now it's a bull market, should you focus your energies and try to take public in this time, or there's no point of timing it?
I think Yashish just gave the right reasons, right? Because he just said that he found predictability in the business, which is really the most important aspect before I think going public, right? Because you don't want to try to make a buck out of retail investor and and then have that bad come off sorts. And in the sense, I don't think you should really be pricing yourself, trying to time yourself. I think it's as soon as there's predictability in the business, and if, of course, if there is opportunity to go public, and there's commitment to investors to go public at some point of time, it does make sense to go in a bull market, right? But about bull markets, like again, Yashish said, it's very tough to call tops, right? I mean, while everyone's saying we are overheated, etc. I mean, we could potentially go like 100% from here now, while everyone claiming it's overheated. I personally also am very pessimistic about valuations, and market, but these trends, sometimes there's so much momentum, you don't know where it takes. So there is a lot of liquidity and etc. So, but it is very tough to go public in a bearish kind of a market. Like it's when there's no demand out there for your stock, generally because as soon as markets go bearish, right, people just stop buying anything and everything, right? Like a lot of my friends, who said at 18,500, I'll buy if Nifty came down 10%. Now that it's come down 10%, I'm like, dude, why are you not buying? I'm like, no, it'll come down 10%. So the decision to, buy, just keeps getting postponed. So it's very tough. I don't think anyone can really time the market as well. So, but as soon as, if there is predictability in a business, and if you're a regulated business, where being public, actually, regulators would, look upon you a lot more seriously, so I think it makes a lot of sense.
Yeah, that's very relevant to fintech companies, because like whatever said and done, most fintech companies are regulated in some shape and form, or will get regulated in some shape and form as they scale. But I have a connected question to this, right? Like you had seen multiple IPOs over the years, right? And right from IRCTC to the fintech companies and others that are going through right now. And I think the profile of some of these companies have started changing, right? Because you have, like, earlier you couldn't go public unless you were a profit-making company in some ways. Now you have loss-making company with the future profitability aspect. Do you think retail investors will also change their outlook on how they understand companies? And do you think, are they looking at some different kind of metrics these days in the kind of IPOs that are happening now? So what is your view on like how that market perception has changed around companies? Or are they still looking for the same metrics that you used to look at earlier, like EPS and other things?
And see, right now we are in a mega bull market. Okay, I don't think anyone's thinking, before applying for an IPO, right? Because getting allotment itself has become a lottery ticket, right? So everyone's, I think right now, at least the IPO application itself, people are saying, what you apply to 10, you'll probably get allotment in 3 or 4, you'll probably make money on 2, and that's how people are looking at it. And but I think like Zomato, I need to give credit, right? I think they kind of changed the image for the new age companies. So until now we've had all pedigree, new age companies coming in. The only, I think, the risk in all of this is that you suddenly have the non-pedigree types, who who are not making profits and claiming a certain user growth, etc., coming and going public, and that might actually end up not very well, right? So I mean, that's one of the things that we are constantly telling our customers, saying, if you're investing in these companies, I mean, IPO anyways, it's become very tough to get allotment, but say on listing you do end up investing. I think you need to look at companies where there is lesser predictability in terms of revenue track record, in terms of financial track record. Just look at it as high risk, high growth, high risk companies, and allocate only a certain portion of your portfolio, right? As in the higher the risk, I think the lower the allocation. So so for a lot of retail investor, it probably makes sense to not have more than 10 to 20% of the portfolio into like high risk, high growth kind of stocks. It's just a better, safer way to play this out.
Interesting. And I think related to that, Yashish, like, have you noticed, or to reframe that, like, are you seeing that like there is certain changes that you need to undertake as a company in the way you build your company once you've gone public? Like the kind of metrics that you chase, the kind of figures that you chase, does that change because you're now a public company and retail investors might be accounting for different things than what, let's say, a PE investor or a public or a private market investor would? Or does that remain mostly the same?
So in our thought process, not much has changed. Clearly, the board has become a lot stronger. So in fact, we have one common non-exec on the board from before public times and post-public times. And that person almost jokes at me that, Yashish, you're a different person in the board now. Because, everybody there is a lot more senior and has a lot of experience. And everybody believes they are a custodian of not just the institutional investors, but also the retail investors.
Yeah.
And let me give an example, right? We were making and it's in the past, so one can speak about it. And this was before we went public. We made a very small investment in a health tech company. Relative to our valuation, very small, couple of $1 million. We had 3 board meetings for it. That would be impossible. Imagine that, right? We had 3 board meetings for it because somebody pointed out, look, you haven't done this. And somebody pointed out, you haven't done this. You also need to do this. And then we went through with it. But the amount of, that diligence that comes in is different. I can't suddenly get up in the morning and say, okay, I want to do this, which I pretty much could as a private company.
Yeah.
Because as a private company, yes, you have investors, but you're dealing with 10, 12 investors. So you can make a few phone calls and you say, okay, my investors are with me, I'm doing this. Right? And yes, you have a board, but yes, you can still do that. You cannot do that as a public company because you have a board in the middle. And you can't just overrule the board. And the board is not, you can't just say, okay, 50% of the shareholders are with me, so I don't care. It doesn't work that way. So I think, one has to think about those things. And, someone like me, I was always 10 years elder to the average, fintech entrepreneur, at least in age. So somebody like me is more capable of is finding themselves, able to handle that situation, while somebody who needs a lot more single person firepower may start to struggle with that situation.
Yeah. But is that also a downside of going public, Yashish, right? Because does that slow you down as a company?
I spoke about it. In fact, one has to be, we are all self-aware people. We have to be cognizant of these things. So I get calls from my friends, saying, "Arey yaar, tumhara to 150 crore ka loss hai. Tum kaise, this, that, and the other." And I tell them, look, please understand, you're judging on the wrong parameter. Who am I to say? Everybody is their own judge. They have to decide, right? And yes, profitability as a question gets talked about a lot more. There's no doubt about it. There's no doubt about it. It gets talked a lot more after public, and the thought is on my mind also. And one is having to explain it, because one understands that by trying to go profitable 2 quarters early, which you could easily, like all of our companies can do that quite soon, right? But sometimes you're destroying the ability of that 0-1. And I think at some level, one has to understand that what we are building is that 0 is building a 1 versus a 0.
No,
And in being able to do that,
I want to ask more about the agility you have as a company, right? Like you said, that as a private company, you could pick up and say, this is exciting. I feel that it's exciting and I can do it. Versus here, you have to now convince 20 people to do the same thing. Is that something that founders should be wary of? That if you're going to take a company public, this is going to be one of the things that you should be prepared. And unless you're at a scale where this can work, you should.
I think the important thing I believe to be aware of is your responsibility is not to 12 people who are actually quite okay if they lose their money because they understand what bet they have taken.
Yeah.
Even the retail investors understand that bet they have taken. But your accountability will be quite spread out. And the negativity you would get if you botch it up is going to be much higher than the negativity you would have got as a private company. You know, a private company going out of business, or, you know, as I said, the 0-1 hitting 0, it's okay. You could start up again. That's fine. But you do that in the public glare, I think it's a different responsibility. I have zero doubt about that. And you'll have to take that a little more seriously. So your risk taking to that extent, you know, as we call it, fail fast. I think if you're in the fail fast mode, my friend, going public is not the right thing. Like, as in, I'm not talking about fail fast or small experiments. I'm talking about fail fast of the whole company. You know, then please don't go public. The retail investor is not the place to do that.
Yeah. Well, that makes a lot of sense. And I think I'll just get around to Nithin, right? Like with it, as you said, like we are in a mega bull runs in one of the recent histories, right? And there's a lot of capital available. And as Yashish said, it's easier for founders to not care too much about capital and deploy it in places and things which might not be as productive, right? So, and this is true for both private as well as public markets to some extent, right? There's enough money in private markets, there's enough more money in public markets as well, right? So in your perspective, like what are some of the things founders should be careful of, right? Like that while this is a bull market, people will go back and look at your report card on certain things.
Yeah. No, see, the thing is, I have been thinking, I know a lot of founders, thanks to whatever last few years, and, and I think the biggest risk is what Yashish just mentioned, right? As in, it's just losing that agility, ability, and a lot of these places, founders actually taking his instinctive, gut-based decisions almost, right, to run the business. I think those kind of businesses will find it tough to, kind of survive in the public glare, right? As in, if your decision, if that, suddenly you have to go through board and, it slows down your decision making, it kind of slows down the agility. I think even in terms of capital, like I personally think you should really take it only if you need it, right? As in, I have different views around, on raising capital, but this whole, just because it's available, just because it's the right time, let me just load up for the next 10 years. I don't know, because I think capital brings along with it obligations as well. So I don't think there's any money that comes without any obligation. And especially if it's public money, the obligation's a lot more, right? And, it's, if people get affected by what, the narrative that runs in, by the press, as soon as you're public, we've seen in the, in the recent, last few weeks, right? As in, so when you're in public glare, you make mistakes, you can, it can have a large lashback as well. So, but I think personally for founders thinking of going public, I think, like just Yashish mentioned, right? I think just losing that agility, right? Can you continue to grow as fast as you're growing without that agility? Is kind of a question I think you need to ask, right? As in, if you have any doubts around that, maybe, going public is not a good idea. And we've seen this, like, in the last few quarters in the US, right? As in stocks losing like 60-70% on one day on a bad, like not even like bad numbers, right? As in just for, kind of being slightly below expectation. So public, once you're public, there is no one large investor keeping your notional valuation high, right? As in, so it is, you'll see the result of, not performing immediately almost. I don't know if everyone's kind of ready for that pressure. Right? As in, in the bull market, you kind of forget all of this, but if market turns around, if a stock losing 30-40% in a day, I mean, I don't know how people's mental framework is, I mean, founders, especially, to be able to handle that kind of volatility in valuation when throughout their journey, they've only seen upward valuation, of sorts.
It happened this Friday. Like we would have seen the US stock tech markets and like companies like DocuSign losing 40-50% in a day, right? So I don't know, like in private markets, you even it's not even in investor interest to do that, right? So it was unlikely
and
that.
Also, I think India, I mean, is while probably debate for another day, but we are very socialist. As in, I don't think in the US you can get away. A company can get away losing money, and people will will not really get jump on you of sorts. In India, I think what Yashish just said, right? I mean, if you were to go down to zero as a public company, I mean, I don't think there's any coming back, to be very honest. I can't think of one person who's taken an Indian company down to zero and had a comeback afterwards. So.
Yeah, well, that's interesting, right? So changing gears a little on the future. And I think I'll start with Yashish. Yashish, you've taken a company to public and IPO, and it has been a very successful IPO. And I think one of the things that private companies think about, what are the future plans? They say, we want to take the company public, we want to take it to IPO at some point of time, right? You have crossed that milestone, right? So what next from there? How do you motivate your team, or what kind of metrics do you set for your team? What goals do you set for your team after an IPO, right? Like, what is the next big thing that they should look forward for?
Yeah. So first of all, I just wanted to say that I thought it would be a bigger challenge, but in reality, it's not proving to be a challenge at all. In fact, people just seem to be, maybe it's too early, but people seem to be supercharged about the future, a lot more than I thought they would be. And a lot more that would financially indicate they should be. Because financially, a lot of, please appreciate, there are people in my company who have, 100 or multiple 100 crores worth of equity, which they can sell today.
Yeah.
And it won't even cause a blip. It'll just go, boop. It'll just happen. Right? There's no restriction on them, nothing. It's their money. They can sell it whenever they want. And they can take it and go. And their salary is meaningless compared to these amounts. But first of all, I've not seen that sale happen. This sort of, I've not seen that happen, which kind of tells me that, okay, these people are believing in the future. And I'm talking about people who don't have a restriction. Probably people are selling 10-15%. There is only one person who's selling upwards of half. And I'm talking about the whole company of whatever, 50, 60 people. These people, each one of them. So one of the first things I told them, even before we went public, that guys, don't destroy the company's ethos. If you want to be lazy, leave now. I'm very happy you've done your job. Don't worry. This is your money. Take it, go. Don't hang around and waste it for everybody else. Not a single taker, but not just in voice, also in, observance. Not a single taker. So that to me has been very, encouraging. See, we can't give any forward guidance, etc. But, people are very, very excited about the future. There are targets they have. There's a particular target they're following for November next year. It does not have to do with profit. It has to do with growth. The company is in a growth mode. The company is in an efficiency mode as a P2.
Okay.
But for the company, the profit conversations are not on the radar yet. For me, they are. But for the company, they're not yet. Since you asked, what are the metrics people are following? Most metrics are growth, customer service, efficiency. In that order, or the first two, you could reverse. It may be customer service first, because in the 0-1, the customer service will become more important than the growth. Right? But they're really about that. And growth in our category is very critical, Because because remember, we decide, we're a marketplace. We don't make our own products. So our scale determines the level of engagement partners want to have with us, right? Whether it is to create products, whether it is to look at our customers differently, whether it is to do special things, etc., etc. So all of that depends on scale. How serious, how much time are they going to put on this relationship, right? And that depends on scale. So if you have more scale, you will, and also from consumers' perspective, you're a consumer brand. So of course, starting to build scale is more important. So I think a lot of focus is on scale and on customer service, with efficiency being the second metric. And yes, we have been in the market very clearly saying not worried about profitability. That doesn't mean not focused on profitability. When you don't worry about something, it is because it's a given. If you have two kids, I'll give you an example. I was running a marathon. I was about kilometer 28. There were two of us running together, and we had a coach. And the coach ran to one of them. Which one did he run towards? The one who was weakening. Because he knew that in the next 14 kilometers, I had to make sure this guy carries on. The guy who's doing well is carrying on anyway. That's my point on profitability. Not worried about it because it is the strong element of the business. The customer service and the growth part are the ones that need the focus.
Very interesting take, Yashish. And I think I have a very similar question for you, Nithin, and which is related specifically to Zerodha, right? Like, you have taken a very clear stance, right? Like in public places, that you're not looking at an IPO, you're not looking at chasing valuations and stuff. So similar for you, right? Like, what are some of the missions that you keep the company connected towards? That okay, this is where we need to be, or this is what our goal needs to be, and how do you drive people to that goal? That given that you're not looking at an IPO on the cards, at least in the near time.
Right. No. Firstly, I'll tell you why not raise capital, right? Apart from the fact that we don't really require money to grow, is that there is no predictability in the business yet. Like what Yashish first said, right? And I don't know what next year, forget next year, what next month's revenue is going to be yet, right? Because our fortunes are so dependent on exchange trading turnover, and exchange trading turnover, I don't think anyone can really predict what Nifty is going to do, right? So until there is predictability, it doesn't make sense for us to go take the obligation from someone else to grow the business at a certain rate, right? So now, apart from that, what is that we are chasing as a business? What keeps everyone in is that I think as a business, we are trying to help people do better with their money, right? As in, people come to us wanting to invest in stocks and mutual funds and whatnot, and our job is to make it easier for them. Our job is to make sure they take the best option. While we have done a great job at making it easier for them, I think we still have to do a lot more to make it, us as a broker who's actually helping customers out take the right choices. And there, we still have a long way to go. So that's essentially what we talk internally all the time, saying, how do we make sure our customers reduce the money mistakes they make with their investments, right? And everyone, I think the core team is all excited about solving for that problem. And it's a really, really complex problem, right? Because every customer of yours has this whole bias, because of his greed and fear and etc. Like, how do you nudge him towards doing what's right for him, right? Stuff like not being concentrated in a stock, stuff like not leveraging. So a lot of these times, when we are trying to tell what's right for the customer, a lot of times these things are not right for the business. A lot of times we end up saying, you shouldn't be taking a trade, right? And it hurts the business because if someone doesn't take a trade, we lose revenues and etc. So currently, I think I still think of ourselves as a startup, and while we have grown in terms of revenue and profits, etc. But that's been just accidental. I think we still have a long way to go in terms of kind of saying, we've built a product, like a complete broking kind of a platform. So once we are there, and once there is predictability, for reasons not for capital, but more in terms of if you're a large player in an ecosystem, in a regulated ecosystem, a public company is looked upon differently, and maybe that would eventually be a reason for us to go public, which is to because we are 10-15% of exchange turnover today, so we are a large institution. So So just for that bit, eventually maybe we will have to go public. But yeah, we're hoping that we have more predictability before we do that. So.
That's an interesting view. I think another question on especially on the future side, right? Like there are a lot of new technologies coming up, and both of you are running large fintech orgs with massive scale, right? There's a lot of these fintech technologies coming up, like blockchain, crypto, AI, and all of those things, right? And there's definitely application at the scales at which you guys operate, right? How do you think about utilizing those in your business? Like, do you create separate teams, or is it coming down from founders? Do your teams look at that? But how do you think of leveraging new technologies to ensure that your business continues to be the most innovative one out there, and somebody doesn't come in and change the way the game is played, right? And I can start with Nithin, because I read your post that came from Kailash around how AI-based trading is not really AI-based trading. So let's start with that.
No, I mean, to be very honest, we haven't found use cases yet. So we haven't really found a use case for blockchain, AI, whatever. But if you were to ask me, I think if there's one potential disruptor for regulated, businesses around savings and investing and trading, I think it's crypto. Because if crypto can kind of work in an unregulated space, if crypto is in a multi-year bull run, it's making a lot of money, and it's eventually, money chases money, right? As in, if there is an asset class that's going to yield you more than every other asset class, eventually money is going to flow towards that. So I personally think crypto as an asset class is a risk to equity. If kind of, and people like us, if it is, in this, if there exists a regulatory arbitrage where we can't offer it for whatever reasons, right? So, but apart from that, we haven't really, we have thought hard about it. We've had many people come and pitch solutions around blockchain, AI, and etc. But no, we haven't. As in our industry, in our business, we haven't found a use case. And in terms of technology, how do you stay? I think our team is a proponent of FOSS, and we are probably the largest contributors back to the FOSS community. So I think there we are still staying ahead of in terms of technologies by using FOSS in the organization. But yeah, is crypto, blockchain, AI, etc., ML, if there's no use case, I don't think it makes sense to force fit use case in your business.
Interesting. Yashish, similar question on your side. Have you seen some of these technologies change the way your segment is run, or do you see that would happen, and how do you stay on top of that?
See, remember, insurances and lending both, actually, although we're not a big player in lending. In insurance, we're a significant player in the pure risk categories of health and life. It is entirely a data play. Between you, Nithin, and me, all three have a different risk on both life and health. That depends on quite a few parameters. And I think there, a lot of what we say, we do, our habits, etc. So yes, and what I have found is mostly the biggest innovations come from the business teams themselves, if they are given enough freedom, because they know the intricacies of exactly where to apply it. The core tech, there may be one person or two people who can help in that. In fact, the health tech acquisition investment that we made, all I can share is there's already been, the founder of that health tech company has now moved into our company. And there are people who moved from this company to that company, from our entity, and we only hold 20%. So we are already finding the benefit in that, and that I think is going quite well for us. But all I'm saying is, so far my experience is sometimes individual entities can have more purpose and speed as they are individual. But eventually you do need to bring it into the mainstream at some level to have real impact. At least if you want to invest in it. Otherwise, it's it's kind of on its own. If it's a strategic investment, then at some point you need to bring it in. And the impact really comes in when the business person understands the use case and starts to apply it in that particular situation. That's my limited experience in that front. We are not a very acquisitive company or a very high-tech company either.
Yeah. No, so I think let me switch gears from that a little bit and go into your personal journeys, right? I think one of the things that is part of building a large company and scaling it up, and now there are thousands of people whose life depend on it, and now when you go public, there are a lot more retail investors who are who have money behind you as a founder, right? Like, how do you manage that, like the stress that comes with it? Because there's a lot of.
I'll give you some real examples of when that happened. So about 20 days before we went public, or 15 days before we went public, some people started trading our stock at 2,300 rupees.
Wow.
And I was feeling very bad about it because I knew that we were going to launch at 980. And I said, man, what do I do about it? And I actually went to our bankers and I said, I want to put out a statement that this is the wrong price. He said, you cannot. You cannot. Now it's in the past, so I can speak about it. Right? It's all in the past. My worry was these people who are coming at 2,300, they want to lose money. And they will create a wrong sentiment. Right? People should not lose money on our watch, ideally. I had nothing else. I wasn't selling, I wasn't buying. But my point was, it just hurt me that thing was going on. And so I think every day the price goes up by a little bit, the price goes down by a little bit. People lose money, people gain money. Eventually, I think people have to be responsible for themselves. We can try our best. We can't be guarantors of price forever. We can't be guarantors of share price gains forever. People have to make their own decisions. I think at some level, you start to treat others as mature people rather than as kids. To some level, we are individuals. And I know all individuals are different. All three of us will be slightly different. We may share some values. And there'll be people who will not share such similar values. My view is in India, for some of the reasons that Nithin mentioned, if you want to be a founder of, and if you want to continue being the leader of a public company, have a 10, 15-year view. Not the typical view we come along, okay, you keep flipping, you keep changing, it's not a toss and turn business. You need to, and the kind of things we spoke about, I think those become quite important. So, I was anyways never good in football or hockey or anything, or even cricket. I was always good at just long distance running. So I'm quite comfortable where I am. For people who are more interested in something else, if you're interested in T20, you need to really think. This is not T20 for sure. So
interesting. Yeah. And I think, Nithin, you would see the same play out at a very different scale, right? And whenever people lose money, sometimes they end up blaming the stockbroker as well, right? Like that, you are the reason I lost it. If my trade had gone in at 5 minutes before this, I would have probably gained money, right? So how do you manage that stress and the push that comes with it from the public, right? That in some ways you are, what Yashish is saying, you'd see it at a different scale play out day in, day out. People are losing money, gaining money, sometimes losing entirely of their life savings on the platform, sometimes gaining. How do you manage that?
Yeah, no, I mean, it is. So one of the reasons we have never got into advisory as a business, and I mean, it's quite easy for us to get into it, which is, to tell people to buy this stock, sell this stock, and etc. It's because of that, it's just the obligation, that brings on the table, right? Because people don't follow advice, even if I give great advice, right? I mean, they'll probably do the wrong bits of the advice, exit out of the good bits of the advice, in the sense, if I ask you to buy 3 stocks, you might decide to buy 1 stock, and that 1 stock loses money, and then you're going to blame me for the rest of my life. So we haven't been able to, solve for that piece. We haven't found a way to solve for the advisory piece where people follow the advice and don't do like a mistake, right? So we have stayed away. So it kind of covers some bit of that problem, right? Because I know a lot of my friends who run broking firms, who run large advisory businesses, who are constantly being blamed by their customers. The second thing is around this tech bits, right? As in every once in a while, it's once, not very frequently, as in once in a year, once or twice a year, we have these 5, 10, 15-minute downtimes. And if markets are moving around those times, so we are the punching bag, and now I've made peace with it. I've made peace with, in 30 minutes in a year, I'm going to be bashed up like nobody's business, So yeah, I don't think there's any way you can build a business without. I mean, every business has positives and negatives. So for us in our business, this 6.5 hours of market time, being down a minute can cause a significant amount of bashing, and people get aggressive. I think social media has just become, it's just getting worse by the day, right? As in, if you're kind of looking at content there, you're gonna get affected. So I've stopped. I don't look at, any of that. That's the way I stay away from that noise. But you have to have thick skin, I think. As a founder, building a business, there's no other way to survive this.
Yeah. Is that a reason, Yashish, you stay away from social media as well?
No, I stay away from social media for a different reason. So I was on social media, but I don't check my phone. Like I might be on a meeting for a couple of hours. I may be on some place, right? So there was this one minister's wife who had asked me and I respond to all my customer queries. So if you are the customer, Harshil, write to me, you will receive a response on average in about 90 minutes directly from me, right? But it just happened that 2-3 days passed and I hadn't checked. I don't check some social media. Like on some places, you're not so active. So she wrote there and then she wrote again. And then she said, what an arrogant guy. He doesn't even respond. And I saw all that and I said, oh my God. And it happened to be a minister who was connected to the finance side. So I was very worried, because those things can have a negative impact on your entire company. So on social media, either you are very active on something. So what I decided was I disconnected from everything except for my WhatsApp and my email. I said, you write to me, you WhatsApp me, you email me. My email and my WhatsApp are always clear. So, within a few hours, I will always clear them out. But I don't want to be on Facebook or on Twitter where I'm not active. I might come there once in 3 days and you write something there and then I'm not able to respond because, to some extent, it's the responsibility we carry for our company. I could have gone and told her that, ma'am, listen, it's okay. I don't check my Facebook account every day. And you are so, powerful, you could have just connected with me in any other way, right? But, it took time to kind of change that impression. So I think you have to be, if you are, if let's say somebody is very active on Twitter or very active on Facebook, then by all means be there. But if you're not going to be active, then I think people have a certain expectation of response rate. And if you're not able to handle that very actively, then might as well just stay away from it. And I don't believe in outsourcing my own work. So when I'm responding to my emails or my WhatsApp, it's always me. It's not like there's a team that is kind of responding on my behalf. Maybe at some point we need to learn. So,
yeah. Well, that's an interesting take. Switching gears on one more thing, right? Like I think both of you guys have built successful companies, and I think I'm scaling it well. I've seen that both of you have also started doing angel investments of your own, right? I've seen Yashish, you have done a couple of investments. Nithin, you have the Rain Matter initiative through which you do angel investments. What are the kind of companies that I look for there, right? Like, do you borrow some learnings that you have from your own journeys and try to look up similar trades, or are you looking at different kind of horizons? How does that strategy look like?
No, I just wanted to clarify. I don't do angel investing. I am not capable of it. I'm not able to understand it. I, in fact, do no investing at all. I have not invested in any stock ever in my life. I have never invested in a mutual fund. I have never invested in anything. I only have fixed deposits, my equity in Policybazaar, and that's it. Now, there'll be a few friends who can come to me and say, I'm starting something. Why don't you support me for 6 months? It's not because I believe their business model is, I just want to clarify, people shouldn't take the wrong impression.
Because you've seen some of the news cycles.
Yeah, I might invest, something between 1 lakh to 15 lakh rupees to support some friend. But I cannot, I know it's a very difficult journey. It's very difficult for me to call who's going to make it, who's not going to make it. I'm saying nothing wrong with it. There are people who can be very good traders. I do not have a trading mentality. I just don't have it. So I don't believe in buying low, selling high. I don't get it. I'm not saying anything is wrong with that. Okay. Please understand. I think it's a very powerful skill to have. I do not have that skill. I do not have the patience for it. I can only build something which is going to become, that's how I am as a human being.
Yeah,
so it's a 0-1, either I'll end up 0 or I'll end up 1, but I won't end up in the middle.
I think we should hear a counterpoint on it on Nithin, because
I'm sure.
and he has definitely done this. And
No. I mean, the only thing I've done in my life is buy low, sell high.
He should be able to comment well on that.
And not sell at all.
Not sell at all too.
Yeah, which is
yeah. So we started Rainmatter in 2016. Right? The idea was that we figured the capital market ecosystem is quite shallow, and we didn't want to go attempt every way to solve this problem, right? And we said, let's partner with startups and do it. And we had this whole broking as a service, like a Kite Connect suite of APIs for which, through which startups could build on top of us. So when these startups came to us, and when fintech wasn't hot, this is not even fintech, investment tech, right? No one cared about. That time we realized that these companies also needed capital. So we started cutting checks between 1.5 to 2.5 crores types. And then that portfolio slowly over time just grew. So today, I think what I'm really passionate about amongst all the investments are all these startups who are building niche platforms to make the lives of people who invest in the markets better, right? And there are almost 20 of them today. And I think some of the coolest fintech startups working on the problem of saving, investing, goal planning, all of them are part of this portfolio. So I'm very excited that, outside Zerodha, the most excited I am is actually about this. Somehow I played a small role in kind of enabling all of these platforms. The other thing that we did was, as the profits of the business grew and lifestyles didn't, there was, we kind of realized that, we need to start giving back, because this whole concentration of wealth is a problem on this planet, and it's only going to get bigger. And wherever there's concentration of wealth, people need to kind of do something to give back. And that's when Rainmatter, the foundation, started. Before we formally set up the foundation, I was trying to give, the team hates if I say give back, they say invest in future. So, I found it very tough to find, invest into non-profits, right? Because, the skills required to invest in non-profits very different as compared to what's required for profits. So we have a nice team. And then through the foundation, we've now decided to give away most of our success as a business. And very exciting, there we are supporting startups working on climate change and nonprofits working around climate change, creation of livelihood and all of that. So I think, it's outside Zerodha, it's the most exciting thing of my life, actually. So I enjoy that quite a bit.
Yeah, we're running out of time, so we'll have one audience question. But before that, I want to add one more question to what you just covered, Nithin. Would Zerodha ever look at building something like what you're doing on the private market side, something similar like that for the ecosystem at large, right? Because you guys are big in the public market investing space, and there's a lot of action happening in private markets. A lot of similar platforms have been built for private markets in US. Would you ever think of doing something like that for India?
No, I don't think it's even the right product for retail investors. I don't think retail investors should be putting money in startups. It's just too high risk. I don't think, you go ask any retail investor and ask him a question, are you okay with your investment going to zero? Right. And no, I don't think, majority of, and HNIs anyways have access, right? HNIs have platforms like Let's Venture, AngelList, etc. to invest, if they want to allocate some portion of the portfolio. I think retail investors don't really, I don't think the risk profile, at least in India, kind of fits to be able to investing into startups as such, So maybe, as I said, as India grows, as the risk-taking ability of the country grows, maybe in a future sometime. But today, I think it's a little too early. I think even if you look at the SME segment on the exchanges, where the smaller companies come and list, that has been a chaos. I think retail investors are net lost a lot of money in that. So maybe not.
Yeah. Great. So I think just one question, maybe one or two questions we'll take from the audience. I know we are running out of time, but one simple question that has come in, that any book that you recommend that founders should be reading, in it could be generally for founders or maybe fintech founders in particular, Nithin or Yashish, any books that you recommend?
I found the book by Peter Thiel, 01.
Yeah.
Very aligned to my thought process. And so I really liked it. Like I remember when I was at, MBA, they used to teach us this thing that NPV cannot go down if you have another option. And I used to always argue, no, options take your NPV down because your chance of success on your primary option goes down. And obviously it was like a stray idea which nobody really thought much about in our MBA class. I think in the entrepreneurial class, everybody would agree with that idea. So I really like that book because it just talks about that building. Yeah.
Interesting. Nithin?
I mean, I think the recent one I read was Debt by David Graeber, and also this is around the obligations of money. So and how debt has played out over the last 5,000 years. It's a very interesting book, and I think for founders, especially when you're raising money, etc. This whole obligation of money. I think it's a good read.
Okay, I think thanks, gentlemen, for this amazing session. I have just one last question, closing question before we go. One piece of advice for founders who are building fintech companies today and who might want to take it public some point in the future. Yashish, why don't we start with you?
I think let's keep the focus on the customer. Obviously, in any fintech, I think that's the obvious one. But if you are planning to go public, then a little bit of predictability is important, and think 10 years at least.
Interesting. Nithin, with your views on fintech, side views?
How to echo whatever Yashish just said. I think in this whole regulated world, it's very easy to generate revenue by mis-selling a product, right? How do you not do it is really the question, I think, because it comes back, in today's world, where everyone's socially connected. If you're trying to build a fintech business by mis-selling or overselling, it's gonna come back to you. I think it's about keeping customer first kind of an approach and doing what's right for the customer and keeping a 10-year horizon. Eventually good word spreads and you can grow a decent business.
Great. Thanks, Nithin. Thanks, Yashish, for joining us. And this has been an amazing session. I think I learned a lot myself as a fintech founder. So thanks for all of this and wish you both another amazing year of success. Thank you.
Thank you so much, Harshil. Thank you. Thanks. Bye, Nithin.
All right, guys. Thank you so much. That wraps up day one of FTX 2021. We've had joy, we've had fun, we've had sessions in the sun. Remember, you can share your experience on all your social media using the hashtags FTX'21. We hope you had a great time with us and our panelists. And this is only the beginning, because day 2 is packed with even more sessions and conversations and maybe even one argument, I am hoping. I've been your host, Karan Gill, and I will see you tomorrow bright and early at 10 a.m. And the first panel will start at 10:30, but you can do some networking before that. Hopefully find a co-founder for that startup. And wish you all the best. See you guys tomorrow. Bye-bye.